Hey there, and welcome. My name is Giovanna, and I am the founder of Flow State Financials, where we help small business owners and entrepreneurs find clarity and confidence in their finances. Today, I'm walking you through a calm, clear introduction to Accounting 101. No jargon overload, just real explanations, examples, and how this applies to your business. I love talking about this because as a small business owner, I have been so grateful for my professional accounting experience. However, I know that not all entrepreneurs have this background. So, I hope this video helps clear up some accounting concepts so you too feel confident talking about your finances. Okay, let's get into it. Accounting at its core is the process of tracking money flowing in and out of your business so you can make smart decisions, stay compliant, and really understand what's happening. Having clean books is like having a clean windshield. You can see what's ahead. Without them, you're guessing, and guessing in business can get expensive fast. Good accounting helps you know your profit or loss, prepare for taxes so there are no surprises, and make informed decisions around spending, hiring, and growing. And it's not just for tax season, it's for year round clarity. So let's clear up something that confuses a lot of people: cash versus accrual accounting. Cash accounting means that you record income when the money actually hits your account, and you record expenses when the money actually leaves your account. This is the simpler form of accounting, and most small businesses start here. On the other hand, in accrual accounting, you record income when it is earned and expenses when they are incurred, even if money has not moved yet. While more complex, this does give you a more accurate picture of your business, especially if you deal with invoices, prepayments, or if you carry inventory. So, as an example, let's say that you complete work in March and send an invoice on March 21st. However, you have net 30 payment terms and your client doesn't actually pay you until April. In the cash accounting method, your income would not be recorded until April when you actually get paid. However, using the accrual accounting method, your income would be recorded in March since that's when the work was actually completed, even though you have not been paid yet. So, as a personal example, I used to own a yoga studio and I would sell class packages. Now, let's say someone bought a 10 class package and paid me the full amount upfront. I used the cash accounting method, so I recorded all of that payment as income right when I got the cash. However, it's important to realize that I actually hadn't earned that income yet because I still had to provide 10 classes for that customer. In accrual accounting, I would have tracked each class as income once they were used. However, you can see how this is a lot more complicated and why most small businesses opt for the cash accounting method. So, the choice between cash and accrual really depends on your business and the types of insight that you need. Now, let's zoom out a bit and look at the big picture. Every healthy business tracks three core financial statements. First is the income statement, or profit and loss, or P&L. This shows your revenue, expenses, and profit over a period of time. And it answers the question, am I making money? Second is the balance sheet. And this is a snapshot of your assets, liabilities, and equity at a single point in time. And this answers, what do I own? What do I owe? And what is left over? And 3, we have the cash flow statement. And this tracks the actual movement of cash. So, what is coming in and what is going out. And it is important to note that this is not the same thing as profit. You might run a profitable business, but still have cash flow issues. All 3 of these statements work together to tell the full financial story of your business. And if you ignore one, you're missing a key chapter. Okay, now let's talk about double entry accounting, which I promise sounds scarier than it actually is. The basic rule is that every transaction affects at least 2 accounts. One gets debited and one gets credited. And this way, the books stay in balance. So let's circle back to those key financial statements that we just talked about. Remember the balance sheet that I mentioned? This is going to become very important here. At its core, accounting is built on a simple equation. Assets equals liabilities plus equity. So let's talk about how transactions flow through this equation using double entry accounting. As I mentioned, every transaction affects at least 2 accounts, so it always stays in balance. And because we're used to hearing the words debit and credit in the terms of a debit card or a credit card, it might start to feel a little counterintuitive. So, what I want you to do is completely forget everything that you think you know about the word debit and credit. To keep things super simple, think about it like this. A debit increases anything on the left side of the equation. So that would be your assets. A credit increases anything on the right side of the equation. So your liabilities and equity. I like to remember it as DC. The left gets increased with the debit, the right gets increased with the credit. And I guess technically it could be CD as well, but think about money, taxes, government, Washington, D.C. So let's talk about some examples of assets, liabilities, and equity. I'll also include a broader list linked below so you can always refer back to that as well. Some examples of assets include cash and cash equivalents. So this might be physical bills that you keep on hand as petty cash or money in checking, savings, or investment accounts. Accounts receivable or money that is owed to you. Equipment such as laptops, vehicles, or office furniture. If you sell products and hold inventory, that inventory is an asset as well. Liabilities, on the other hand, includes everything that you owe. So, for example, accounts payable or bills that you have to pay. If you took out a loan, you'll have loans payable as well. And here's where it gets interesting with accrual accounting. Technically, if you get paid for services that you have not provided yet, that is a liability. And you would use an account called deferred or unearned revenue. On the other hand, if you prepaid for an expense, that is actually an asset, and you would use an account called prepaid expenses. So, for example, let's say that you have a large insurance bill that you only pay once a year and it covers the entire upcoming year. That would technically be a prepaid expense that you would account for as an asset when you pay it. Then you would expense out a portion of that payment for every following month. And this is where a principle called materiality comes in. So, for example, I prepaid for an entire year of my website hosting platform. It was only around $200. And while technically I should mark it as a prepaid expense, I just put it straight to my software expense category. The $200 did not feel significant enough to me to spread out over the course of a year. On the other hand, if you have a $10,000 insurance bill, I would highly suggest that you spread out that expense over the year. Finally, let's talk about equity. As an owner, this will include money that you put into the business and money that you pull out, or owner's contributions and draws. And while this is still the balance sheet equation, this is where the profit and loss or income statement comes into play. Now, stick with me here. A component of equity is retained earnings. And part of retained earnings is the business's profit, which is revenue minus expenses. So in that case, revenue increasing will also increase net income. However, expenses increasing will decrease net income. So, since equity is on the right side of the equation, we increase it with a credit. And in this case, revenue increases equity, so revenue would be a credit. However, expenses decrease equity, so expenses would be a debit. And if this feels confusing to you, I promise you are not alone. I have taken many accounting classes. I read accounting books. I have done accounting professionally for years. I love this stuff. But I will be totally honest, it really took me a while to fully grasp. So I will also link a handy little chart where all of this is laid out for you. But let's quickly run through it one more time. The equation is assets equals liabilities plus equity. The left side, assets, gets increased with a debit and decreased with a credit. The right side, liabilities and equity, gets increased with the credit and decreased with a debit. And then within equity, we have revenue and expenses. Because equity gets increased with revenue, revenue will be a credit. And because equity gets decreased with expenses, expenses will be a debit. Whew, okay, I know that was a lot. Let's play with some examples that I hope clears it all up for you. So let's say that you buy a new laptop with cash. In this case, two asset categories will change. Your equipment, or the laptop, will go up, and your cash will go down. So in this case, one asset went up, a debit, and one asset went down, a credit. And we're still in balance. Now, instead, let's say that you got an invoice for this new laptop purchase. In this case, we would still increase the equipment asset account with a debit. However, instead of decreasing cash, we would actually put this into accounts payable, which is a liability. And since a liability is on the right side of the equation, we will increase that with a credit. So now we will have a debit to increase the asset and a credit to increase the liability. And we're still in balance. Now, let's say that you receive payment from a customer. You would debit your cash account since that is an asset. And then you would also record revenue, which, as we discussed, is a credit. A debit to increase the asset and a credit to increase revenue, and we're still in balance. And finally, let's say that you pay rent. Your cash, which is an asset, would actually go down, which means that instead of debiting it as we usually do, this will be a credit. And then your rent expense will go up. And since expenses decrease our equity, the expense would be a debit. So you debit rent expense, credit cash, and you are still in balance. Now, one thing I want to mention is that when I say cash, I don't always mean cold hard dollar bills. Cash can certainly be a transfer from a checking or savings account. And this is why it is so important to do regular reconciliations of your banks and credit cards. Expenses paid for on a credit card will actually be a liability until that credit card is paid off. So we would be debiting the expenses and crediting a credit card liability account. And then once that credit card statement is paid off, we would debit the credit card liability to decrease it and then credit the cash account to decrease the money that was sent out. And again, if this still feels confusing, you are not alone. And that's why bookkeepers and accountants are here to help you. And if this feels like a lot, I do have some good news for you. When I was learning this in college, we had to actually write out T charts and memorize all of the debits and credits. However, with modern accounting software, like my favorite, QuickBooks, this is made so much easier. So, while the good news is that you are no longer doing this by hand, I do think that understanding the logic behind it is so helpful for small business owners. So, let's wrap this up by quickly talking about how software can make accounting so much easier. Tools like QuickBooks Online just make the process so much smoother. You can sync bank feeds, categorize transactions, generate reports, invoice clients, and track revenue and expenses. If you are doing this manually in a spreadsheet, you are spending way too much time and possibly risking errors. I'll be making more videos breaking down how to use QuickBooks step by step. So be sure to subscribe and stay tuned for those. So that's Accounting 101, the flow state version. We covered why clean books matter, the difference between cash and accrual accounting, how your financial statements connect, the basics of double entry accounting, and how software can make it all easier. If you're feeling overwhelmed by your business finances or just want to make sure that you are set up for success, I'm here to help. Reach out for a free discovery call, and I would love to support you. Our website is linked below, and you can always catch me via email and check out our blog and additional resources. Don't forget to like, subscribe, and follow along for more financial tips. Thanks so much for watching, and please remember that your numbers do not have to feel scary. With a bit of guidance and support, they can be a powerful tool for clarity, peace, and flow. Thanks again for being here, and I'll see you in the next video.